Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin Wong here again. So, very good morning. Today will be Thursday, the 9th of May. So, before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice for any recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so before we jump straight into the short-term technical outlook, let's have a recap of what has taken shape in terms of the price action on the broad-based cross-asset classes, as well as its related and respective news flow and data. So yesterday was more like in terms, let us start with the US major stock indices first. So yesterday, US major stock indices was quite lackluster. So I would say it's more like a sideways kind of configuration. Why? So if you look at the benchmark US major stock indices, I would say the S&P 500 ended almost unchanged by the end of yesterday US session. The Nasdaq 100 almost unchanged as well, despite they are down by negative 0.4%. But the Dow Jones Industrial Average actually outperformed with a gain of 0.44%. The Russell 2000 underperformed with a loss of negative 0.46%. All right. So overall, it's a rather mixed session. Why? Because we have conflicting elements that's actually taken shape in the US stock market yesterday. If you look at the entire heat map of the US 500, the S&P 500, the Dow Jones Industrial Average was actually outperformed by a gain of positive 0.4% due to the outperformance of the major US banking stocks, as well as some of the industrial stocks as well. That actually led the Dow Jones Industrial Average to actually outperform. But however, the S&P 500 and the Nasdaq 100 that is heavily skewed towards the technology big cap stocks, or we call them the part of the cohort of the Magnificent Seven, actually underperformed due to Google negative 1%, Amazon down negative 0.4%, as well as some of the chips sector or the chip I would say that the major chip stocks or semiconductor stocks where Intel is down negative 2% and Nvidia almost lackluster as well, down negative 0.16%. So the reason of the lackluster performance on this AI or chip related stocks is due to the fact that the US government actually revokes the current license by Intel and Qualcomm to sell chips to Huawei. So as we know that on the surface, we may see some kind of a diplomatic relationship mending between the US and China, but on the backdrop, they are in the state of constant rivalry between getting the best technology know-how in this high-tech technology space, which involve artificial intelligence. So yesterday, US government actually revoked this the current license of Intel and Qualcomm has towards selling of this not really that high-end chips, but those mid-tier and lower chips to Huawei. So now they start to put a ban as well. So with that, actually Intel yesterday made earnings guidance stating that due to this latest ban itself, they could see revenue falling below the midpoint. All right, so that actually has this kind of negative feedback loop into the US stock market that's impacting the semiconductor stocks. So that's why they just explain why the S&P 500 and the Nasdaq 100 was actually kind of lackluster in yesterday performance yesterday, whereas the Dow Jones Industrial Average actually outperformed due to a strong performance in the US banking stocks and industrial stocks. And also in terms of Federal Reserve official speech, we call it the Fed speak. So there's this particular officer, Collins. So she also did actually highlighted a less dovish stance or guidance, saying that reaching that 2% inflation goal may take longer. All right, and she also mentioned obviously that progress will be likely required slower economic growth. So what's her intention implied over here is that she actually is in favor of not be so aggressive of cutting interest rate this year based on her speeches yesterday. So that actually also saw the US 10-year Treasury yield ticking up as well as the 2-year. So if you look at the US 10-year Treasury yield yesterday, okay, so it managed to actually stage a bounce, okay, close right above the 50-day moving average. All right, so what you could see over here is that prior to yesterday, there is actually this bullish hammer, and yesterday it formed this positive close above the high of that bullish hammer. So what we could see over here at this point in time, there is a potential signs of a bullish reversal taking shape into the 10-year US Treasury yield. All right, and also what it means that potentially we may be on the crisp of staging another potential impulsive up move within this medium-term uptrend phase that is still intact in the US 10-year Treasury yield, as seen from that ascending channel that I drew from the low of 1st of February. Okay, so now momentum got to actually be more forceful. Upside momentum got to be more forceful once it break up above the back above the or reintegrate back above the 20-day moving average that is acting as a resistance at around the 4.6 level. Okay, so this is the 10-year US Treasury yield. So if you look at the shorter term one, which is the 2-year, that is much more sensitive to Federal Reserve official policy guidance. It's actually staged a bounce right exactly at the 50-day moving average and the 20-day moving average. Okay, so this is a key pivotal support. Okay, over here at 4.75, and similar to the 10-year, it got to actually reintegrate back above this level here, which is 4.94%, which is the 20-day moving average that is acting as a near-term resistance right now. So what we could see over here is that very similar, the 2-year Treasury yield also is on the crisp of shaping that potential bullish reversal to kickstart another round of impulsive up move within its medium-term uptrend phase that is still intact. Why? Because like I draw this ascending channel. Okay, let me highlight in 1, 2, 3. Okay, over here. Okay, so this is what I call a medium-term ascending channel where the price action going to evolve within this channel. And what's interesting over here is that last Friday's sell-off managed to stage that bounce off the lower limit of the channel, and it managed to find support also right at the 50-day and the 200-day moving average as well. So net, what you could see over here is that the push down on last Friday, i.e. ex-post FOMC and ex-post non-farm payroll data, the US 10-year Treasury yield is not showing a sign of a dramatic sell-off, instead from a technical perspective, but however, they are showing signs of positive bullish reversal price action coming back into the picture. So that actually also will lead to a further support of that ongoing US, we call it dollar strength revival coming back, at least in the short term. So bear in mind, the dollar strength actually came much earlier at the start of this week. Why? Because you look at the US dollar index, it managed to actually bounce off the 50-day moving average on Friday, and we start to see 1, 2, 3 consecutive of up move in the last 3 days starting from Monday. So in fact, the US dollar managed to actually shape that recovery much earlier than the potential recovery seen in the US Treasury yield that took shape 2 days later based on the chart that I shared with you all. So overall, if the US 10-year Treasury yield going to have that positive follow through as well as the 2-year, this potential US dollar index may continue to shape its recovery going forward. So yesterday we do see another round of dollar strength coming back into the picture, but later I'll share with you a particular short-term technical chart on the dollar yen, which has been coming very close to hitting the first resistance at 156 figure level. There could be chance of a pullback in the dollar strength against the yen, supported by another technical element or the intermarket factor, taking into account of the spread between the US 10-year Treasury yield and the JGB yield, which is the Japanese government bond yield. So later I share that more into you guys to see when I cover the short-term technical outlook on the FX market. So overall, then this particular morning, what we could see over here is we do have some key data to take note of. Will be okay. Yeah, balance of trade. So while we are speaking over here, China releases the balance of trade. So data pretty much positive on the export side of the story. It's much stronger than expected. 1.5% year-on-year growth for April versus a negative 7.5% year-on-year for March, and also surpassed the expectation of 1%. So if you look at the trend of the earnings growth at this point in time, okay, it managed to finally go back to positive growth territory again. All right, on exports side of story, and from imports as well, it managed to actually surpass last month or the previous month of March of negative 1.9% growth. It came in at 8.4% positive year-on-year growth for the month of April, and also surpassed expectation of 5.4% year-on-year growth. So overall, if you look at the imports trend as well, okay, it managed to actually stage a recovery in April. So that actually also indicates to us that domestic demand in China, because imports related to domestic demand, yeah. So indirectly, okay, so indirectly domestic demand in China is not actually going further into the doldrums. So what it also imply this positive 8.4% recovery on the month in the month of April also reduces that deflationary risk spiral as well. So that could actually kickstart into what I call a short-term positive momentum into the China benchmark stock indices, as well as its related proxy, which is the Hang Seng indices. So later I'll touch on the Hang Seng stock index. Okay, then over here, what other data that came out is the Japanese data at this point in time. So Japanese data, that's actually pretty much lackluster in terms of cash earnings. So this is actually average labor cash earnings. So instead of, we know that the month of the start of this year, which is 1st of April, there's actually this negotiation going on between the union and the labor union and the employers. So they managed to secure a rather rosy wage hike. Okay, but however, this wage hike hasn't been transformed yet into the market. This is for the month of March. It's not April, March. So that is still 1 month before the negotiation concluded. So during this, the next couple of months we should be able to see much more improvement, but this rather lagging in nature. So what we could see over here is market is expecting 1.5% year-on-year growth, but it came in at 0.6% year-on-year growth, and below the month of February at 1.4%. So bear in mind, this is the quite lagging, because it's only in the month of April where the labor union managed to secure a much more drastic improvement in terms of the wage hike that they secure for their employees. So this is much more lagging in nature. So we should be able to looking at the next month data in April to see whether there will be a much more forceful increase in the average labor cash earnings. Okay, so if you look at the trend, right, this is lagging, this is for the month of March, like a stretch again. Why? Because at that point in time, that so-called wage negotiation between the unions and the employers has not been concluded yet at that point in time for the month of March. Okay, so if you look at the trend, the 5-year trend is kind of sideways. So very interesting to see whether when we start to see next month's data, where they start to reflect April figure, very likely it may start to actually hover around the 2% to the 3% level, given that much more higher wage increment that has been negotiated by the labor unions with the employers, but that only takes shape in April this year, whereas this data only reflect March data, so it's lagging. So what's interesting over here, one more thing to look out for before we go down to the technical outlook, is the statement. Because in Japan they call it summary of opinions, which is the previous monetary policy minutes. Okay, so during the minutes over here, okay, so the Bank of Japan flagged upside risk to inflation and indicated that it's ready to adjust monetary policy but expect the accommodative financial condition to remain for the time being. So still no change. And what you could see over here is the key factor is to monitor further policy adjustment, including corporate behavior through this summer and improving trend in consumption. That means what you want to actually expect is, number one, business sentiment, corporate spending for the next 2 months. That means talking about June and July, and as well as an improvement in domestic consumption together with wages in the month of summer. That means we're talking about data point from the month of July to June. Then that means very unlikely for the next 2 months in July and June, BOJ is going to hike interest rate, but rather they use the data point at this point in time to determine the potential next decision could come in September. That means this is where we start to see a slew of summer economic data, whether does this domestic and domestic consumption and business consumption improve in Japan before BOJ starts to actually think about the next interest rate hike. So very likely June or July there will be no hike, and the next possible hike will be in the month of September instead. All right, so this is the summary of opinion or the minutes of the previous monetary policy that has been flagged out between the discussion among officials. All right, so with that, that is the key data point and event to actually that's taken shape yesterday and today's early session. So now let us now jump straight into the short-term technical outlook, starting with the FX market first. All right, so we know the FX market, the dollar strength continues to remain robust yesterday. So what do we have in store for the European currency? So Euro currency continues to remain lackluster against the dollar. Okay, let me start with the euro dollar first. Over here, let me expand my screen so that you guys could see. So on the euro dollar, what we could see is yesterday the price action traded sideways, hit the first resistance before reacting towards downward, but can't break below the near-term support at 1.0730. So it's more of a sideways kind of a range configuration in terms of the short-term technical outlook. So I don't want to type the short-term pivotal resistance to so tight to 1.0755. So I will still use the 1.080 level, which is the 20-day and the 50-day moving average and the 200-day moving average, confluencing at the similar pivotal resistance level as well at 1.08. So as long as this 1.08 level is not surpassed to the upside, first support level to watch out for is 1.0730. A breakdown below 1.0730 exposes the next support level for much more euro weakness against the dollar at 1.080/1.0635. Okay, I repeat again, 1.0680/1.0635 if 1.0730 is taken down on the downside. However, an hourly close above 1.080 level will negate this short-term bearish bias within its range scenario to see a potential squeeze up or a continuation of this counter trend rebound scenario to expose the next resistance level at 1.0850, 1.0880 next. Now, what's next for the sterling dollar? Okay, so later there's a key event that's taking shape on the sterling dollar today will be the Bank of England meeting. So later I'll highlight the what time to look out for towards the end of the daily dose. So ahead of the Bank of England meeting for today, the sterling dollar continues to actually be depressed against the US dollar. So it continues to trade downwards, inching below a series of lower high and as well as below the 200-day and the 50-day moving average as well. So still no change. I'll be still using 1.2565 as my pivotal resistance for today. So I don't want to put it so the first resistance to look out for will be at 1.2540, this level here, which synchronized with previous minor swing low breakdown, turns into a pullback resistance. I don't put it so tight, so I'll put it at 1.2565. We also confluence with the descending trend line resistance that I drew from the high of 8th of March. So first support level to watch will be for sure at 1.2460. Yesterday it came down, almost tested it during the European session before trading sideways. So a break below 1.2460 will potentially expose the next near-term support level at 1.2390 for today on the sterling dollar. Only hourly close below 1.2565 will invalidate the short-term bearish bias on the sterling dollar to see another round of a counter trend rebound to retest 1.2640. That was last Friday's swing high, followed by 1.2710. That is the minor swing high area of 9th of April and 10th of April. Okay, so that's for the sterling dollar. So potentially there could be much more, we call it dollar strength coming back into the euro and the sterling, given that they are the euro dollar and the sterling dollar are still trading below their respective pivotal resistance level ahead of Bank of England meeting today. Asia Pacific currency. So let us start with the Aussie dollar. So Aussie dollar yesterday traded sideways around the first support level at 65.75. So with that, what we could see over here is it's going to do a sideways configuration. So what we are expecting, we're still using that 64.45 for sure. That is the short-term pivotal support resistance level. So as long as this short-term pivotal support level, pardon me, as long as this 66.45, I repeat again, short-term pivotal resistance on the Aussie dollar holds, potentially we could see another round of minor weakness to retest the lower limit of this minor ascending channel that I drew from the low of 19th of April. So this level now is at 65.50 level. Okay, 0.6550. 50 level with a maximum limit. Okay, so I'll remove this. I'll remove this. I'll remove this. I'll remove this. Okay, with a maximum limit set at 65.20, which confluence with the 200-day and the 20-day moving average. All right. So just a little minor more deep down before another recovery taking shape back again on the Aussie dollar. Okay. So right now, however, if we start to see the price action breaking up above 65.45, then forget about this minor push down on the Aussie dollar. This is where we'll kickstart another round of potential up move within its symmetrical triangle range configuration on a medium term basis. Next resistance to watch after 66.45 will be 66.80, followed by the all important 67.30 level. Okay, why 67.30 level is important? Because if you look at the daily chart, 67.30 level is actually the upper boundary of this symmetrical triangle range configuration on the Aussie dollar that has been in play since the low of 13th of October last year. Okay, you look at these two gray line. Okay, so 67.30 now is the upper limit of this symmetrical triangle range configuration. So I could see now the Aussie dollar is actually being sandwiched sideways between this symmetrical triangle range configuration. All right, on the daily chart basis. That's for the medium term time horizon. Now, Japanese yen. So the Japanese yen, the dollar yen, continue to inch much higher, holding above, breaking above the 200-day moving average, not 200, the 20-day moving average yesterday. So what we could see is that yesterday it came very close to the first resistance level that we highlight at 156 figure level, almost reached already. But as price actually going to churn higher, if you look at the momentum on the hourly RSI has started to flash a bearish divergence. So indicating to us there is potentially risk of at least a minor setback coming into play for the dollar yen. All right, the dollar yen. Why? Because of this bearish divergence, and you also come very close to the 156.10 level. That's the resistance level that we highlighted yesterday, and also the 156 figure level of 156.10 correspond to that golden ratio retracement as well. 61, if not golden ratio, the 50% Fibo retracement. The golden ratio is at 157 figure level. All right, at least the 50%. So, but however, not hitting the golden ratio, but hitting the 50% is pretty much significant as well, because it's previously a minor swing low, and as well, given that bearish divergence that is seen on the hourly time frame of the RSI, there's a risk of a minor setback, minor bearish setback scenario potentially unfolding for the dollar yen. So with that negative technical element on the short term on the dollar yen that's being flashed out right now, we will flip to a short-term bearish bias intraday 156.10 short-term pivotal resistance for this potential minor bearish setback scenario potentially that could unfold on the dollar yen. First support level to watch will be at 154.55. A break below 154.55 exposes 153.30 next on the dollar yen. Okay, and also what's supporting this bearish unfolding of this minor setback scenario for the dollar yen is also the JGB yield curve. So if you look at the JGB yield curve over here against the dollar, okay, not the JGB, the US Treasury minus of the JGB yield curve, which is the yield spread. So it's the 10-year US Treasury minus the 10-year JGB. So if you look at over here, the 10-year Treasury right now is actually trading at a slower pace of up move versus the 10-year JGB yield, which is moving at a faster up pace by taking the difference between these two. So you look at it over here, is right now testing the lower limit of this ascending channel support level. Okay, it's testing it, but in fact previously it started to break the previous level. Okay, so there's a bit of yield premium shrinkage between the 10-year Treasury yield minus of the 10-year JGB yield. And if you look at the shorter term 2-year JGB yield, okay, this one very similar as well, is also testing the lower limit of the ascending channel support level. Okay, so it doesn't seem to be reverting upward, it seems to be facing much more downside pressure as well. So it seems to us that even the 2-year Treasury yield is actually trading at moving upward at a slower pace versus the 2-year JGB yield. That means the yield premium of the 10-year Treasury over the 2-year JGB yield is facing the risk of a yield premium shrinkage. All right. So with that, that also potentially supports a dollar weakness story against the JPY, Japanese yen, at least from a short-term perspective intraday when I share, okay, with this chart over here. Okay, so these are the key levels to watch out for. If it didn't surpass above 15610, the dollar yen may potentially shape that minor bearish setback scenario. First support to watch 154.55, break below 153.30. Only an hourly close above 15610 will invalidate this short-term bearish setback scenario on the dollar yen to continue the dollar recovery story against the Japanese yen. Next resistance to watch will be at 157, followed by 157.90. No, okay, pardon me, a bit of time to stick 157.90. All right, so overall, just I covered the major FX technical. Potentially, we do see some form of dollar strength still intact against the euro, against the sterling, against the Aussie, but not against the Japanese yen because of that weakness display inherent in the dollar yen hourly RSI, and as well as the intermarket correlation between the JGB yield, where the 2-year Treasury yield and the 2-year JGB yield, that yield premium may face a bit of a yield premium shrinkage that supports at least a short-term dollar yen weakness. Okay, similar to the 10-year JGB yield premium as well. Okay, against the 10-year JGB yield, the 10-year Treasury yield against the 10-year JGB yield. Okay, the yield premium shrinkage. Okay, now with that, let us take a look at spot gold. Okay, before we jump into the short-term, the major indices. So spot gold, no change, right? Continue to hover sideways, holding above the 265, 260 short-term the pivotal support level. So still expecting a bit of sideways movement, but in order to see momentum coming back, you got to break above the 2365 level to expose the next intermediate resistance at 2420. Okay, 2420. Only an hourly close below 2265, 2260 will negate this potential recovery to see the extension of this minor corrective decline to extend towards the next support level at 2235, 2210. So that's for gold XAU/USD. Now, major stock indices, very mixed. So let us start with the Japan 225 first. So the Japan 225 going to be trapped inside this sideways complex range configuration since the low of 19 April. So yesterday price action pushed down, managed to actually come close to 38,010 level. So that's the first support level that we highlighted and stage a bounce. So the bounce actually took shape right exactly at the 20-day moving average, and also the hourly RSI hit the oversold and shaped the bullish divergence. So with that positive element in the short term, bouncing off the 20-day moving average and that bullish divergence that's seen on the hourly RSI, there could be some form of momentum enable it to push up to retest the upper limit of this sideways range configuration, complex sideways range configuration at this 38,810, 38,930. So with that, for today, we'll be flipping to a short-term bullish bias within this complex range configuration. Resistance to watch 38,610, upper limit of the range 38,810, 38,930. Okay, above 38,930, expose the next resistance at 39,130, which is confluence with the 50-day moving average, acting as a resistance at that level as well. Only an hourly close below 38,100, 3810 level, that means this short-term pivotal resistance level, will negate this short-term minor bounce scenario to see another round of extension corrective decline still within this complex sideways range configuration. Next support level to watch 37,680. Below it, expose the lower limit of the sideways range at 37,070 level. All right, so that's for the Japan 225. Hong Kong 33, bullish. All right, so yesterday a bit of excess below the 38,380 short-term pivotal support level, so we have an excess at 250 level. Okay, because today it reintegrated back above 18,380, so 18,380 slash 250 short-term pivotal resistance, short-term pivotal support, pardon me, still maintain that bullish bias scenario to kickstart another round of impulsive up move. First resistance to watch out for will be at 18,800 on the Hong Kong 33. A break above it exposes 19,390 next, okay, which is this 1.382 Fibo extension level, previously taken from the low of 22nd of Jan. And also that 19,390 also confluence with this congestion area over here, 2nd of August and 11th of August last year. Only an hourly close below this 18,250 will invalidate the Hong Kong 33 bullish impulsive up move scenario to see another round of corrective minor pullback to retest 18,000 slash 17,900 level. Okay, so that's for the Hong Kong 33, still maintain that short-term bullish bias. Okay, very strong momentum will be on the German 30 index. Yesterday continued to push up higher, almost hit the first resistance at 18,620, and it continued to trade within this ascending channel configuration from the low of 19th of April. So with that in mind, the RSI now has started to exit from the overbought level. So potentially today there could be another round of minor pullback again. First support level to watch will be at 18,470. Then for today, I will have a much more tighter key short-term pivotal support level at 18,400. So what's 18,400 if you do the Fibo retracement of this entire move up? Okay. Okay, this push up here is actually 38%, 38% Fibo retracement. Okay, so the 38% Fibo retracement also this, okay, this level here, 18,400 also correspond to the previous minor swing high of 8th of April. So as long as any potential minor pullback didn't surpass 18,400, still maintain that short-term bullish bias for another round of impulsive up move on the German 30 or the DAX index. Next resistance to watch after 18,620 will be at 18,710, 18,770, followed by 18,800, upper limit of this minor ascending channel. And as well, if you do the another subset of the Fibo extension, my screen over here, it will be the 18,800 level will be at the 2 times Fibo retracement, right? Only an hourly close below 18,400 will negate this bullish tone to see a much more steeper minor pullback to test the next support level at 18,310, which is crucial. Why? Because 18,310 is the former symmetrical triangle range configuration bullish breakout. This very clearly this minor swing high here now turns into pullback support. Reintegration back below 18,310 will put this impulsive up move in jeopardy. That means we're talking about a failure bullish breakout. Then there we start to see another round of complex corrective decline to retest the next support level at 18,150. So 18,150 also correspond to the 20-day moving average, I think as a support, and also the lower limit of this minor ascending channel. Okay, so still maintain that short-term bullish outlook on the German 30 index with a tighter key short-term pivotal support for today at 18,400. Now, what's next for the major US stock indices? So the major US stock indices, the Nasdaq 100 yesterday remains lackluster below our short-term pivotal resistance at 18,180, but thereafter it came down, hit the first support level at 17, almost hit the first support level at 17,940, printed a low of 17,975, which is right exactly at the 50-day moving average before shipping that bounce up, okay, throughout the middle part of US session. Then thereafter it traded sideways. So element kind of mixed right now, very mixed. So I will have a neutrality stance instead on the Nasdaq 100, neutral between 18,180 and 17,940. Unless we have an hourly close above 18,180, then we will have that bullish breakout to expose the next resistance at 18,380, followed by the all-time high area at 18,500. Then we have the US Wall Street 30, the Dow Jones Industrial Average managed to came down, hit the 50-day moving average and squeeze up towards our short-term pivotal resistance yesterday, then at 19,050 before trading a very tight range thereafter throughout the end of the US session and right now during the Asia session. RSI now managed to exit from the overbought level, so potentially there could be a some kind of pullback. So given the fact that elements are kind of mixed right now and it's going to hover within this minor ascending channel, so unless it could actually break below the 50-day moving average before we start to see a more pronounced minor corrective pullback scenario to unfold to retest the 20-day moving average at 38,330. So with that for today, I will rather have a neutrality stance as well on the US Wall Street 30, neutral between 39,050 and 38,750. But however, if we start to see an hourly close above 39,50, 39,050, very similar to the breakout of the Nasdaq 100 above 18,180, then we got to validate a further up move on the US Wall Street 30 to expose the next resistance level at 39,380, followed by 39,775. That means more or less, right, if it starts to break above 39,050, we are on site for another round of bullish impulsive up move sequence. Okay, so despite the fact that the US dollar is gaining strength, the 10-year Treasury are gaining strength, market is still optimistic about the major US stock indices due to stronger earnings growth and as well as AI optimism that could actually surpass the lack of dominance from the US Federal Reserve that is potentially leading to a higher US 10-year Treasury yield. I would say it's our optimism, but we still got to respect the price action if such bullish price action unfold in the Nasdaq 100 and the US Wall Street 30. So neutral for these two indices for now. Then lastly, crude oil. Okay, West Texas oil yesterday managed to have a test again at the 78.40 short-term pivotal support level, tested it, but managed to shape a bullish reversal candle right after that, and price action going to inch much higher. So indeed, this 78.40 here, yes, despite an intraday test, managed to shape a bounce off from this level. So we know that price action on the West Texas crude oil is still holding on to some form of support level, but in order to see a much more pronounced, we call it recovery, we got to break above this key intermediate resistance at 88, 80. Okay, this is what level? Okay, this is not 80, 80 here. This 81, 70. Okay, you got to clear above the 81.70 level very clearly, which is also close to the 50-day moving average, now acting as a resistance as well. Okay, so we know that there's some form of support still holding at the medium-term pivotal support level, but in order to see a much more pronounced upside momentum coming into the WTI crude oil price market or the West Texas oil, it got to have cleared above the 81.70. Okay, so that's from the daily chart. So on the hourly chart, right, for a short-term intraday perspective, no change at 78.40. So that will be the pivotal support to watch for today. Yesterday, price action had managed to clear above the 79.40 level already. All right, so it cleared above this Monday's swing high, and as well, yeah, this Monday's swing high. So this will be like my first support level to watch. The next resistance level to watch will be at this 80.80. So 80.80, once 80.80 goes above, will be that 81.70 level. All right. Okay, so this is the 81.70 level that is highlighted on the daily time frame. which is also the 50-day moving average, acting as a support and coming close to the 20-day as well. To have much more forceful upside momentum coming into play. However, a breakdown below 78.40, then another round of wishy-washy movement again to retest 76.90, below it 75.55. Okay, so still no change. Potential recovery still intact for West Texas Oil after yesterday's positive price movement at the 78.40 medium-term pivotal support level. Now, before we go, what's next important for today's key data will be the highlight the Bank of England. So Bank of England will meet on at 7 p.m. Singapore time. So it's no change. Market is expecting stamp pad at 5.25% for their short-term cash policy rate. But what's important over here is they will also release their the new latest inflationary and economic growth forecast for UK. So if the Bank of England starts to reduce the inflationary forecast for UK in 2024, that will actually implies to us that the Bank of England is having a much more dovish stance than the US Federal Reserve, and very likely they could follow their cousin ECB to actually enact the first interest rate cut much sooner than US. So that will be potentially in the month of June and July, the summer months of this year, whereas US, they're still looking at the first cut coming in September. So if September they can't cut, the next one will be in December. So that could also start to see potentially further strength in the European currency. That means, i.e., a sterling dollar weakness may also kickstart into transpire into a euro dollar weakness as well. So something to look out for. And thereafter, we do have the press conference from the Bank of England Governor Bailey. He was speaking after at 7:30 p.m. All right. So then, what do we have next over here? Oh, he will speak again at 9:15 p.m. All right. So then thereafter, a pretty much quiet session. Then what we have over here is we do have another Federal Reserve official speaking at 2 a.m. Singapore time. Fed Delhi, he was speaking at 2 a.m. Singapore time. Then thereafter, pretty much quiet. Then what we have over here is that before tomorrow's session of daily dose, Japan consumer spending, we call it the household spending data, will be in the month of March. Market is expecting a rather lackluster number, negative 2.4% year-on-year for March, much more decline, negative 0.5%. So something to look out for tomorrow as well, before daily dose at 11 a.m. Then thereafter, that will be Friday, okay, early Friday time. Okay, so with that, that's pretty much sum up today's session of daily dose of market insights. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.